Here's the housing paradox nobody can explain in one sentence. Existing home sales in America just hit their lowest annual level since 1995. That sounds like prices should be crashing, right? But instead, the median existing home price in 2024 hit a record $407,500. So what is this? A broken market? A bubble that forgot to pop? Or something even stranger? Because in a normal market, if transactions collapse, prices follow. Fewer buyers means weaker demand. Weaker demand means sellers cut prices. That's economics 101. But this is not a normal market. This market is frozen. Not healthy, not cheap, not balanced. Frozen. And in this video, I'm going to walk you through every domino and order with real numbers, real incentives, and real math, not the usual real estate industry fairy tale that says, just keep saving and your time will come. To understand today's housing market, you have to go back to 2020. COVID hits, the economy shuts down, panic spreads everywhere, and the Federal Reserve responds the only way it knows how in an emergency: slash rates, flood the system with liquidity, and make borrowing absurdly cheap. That's how America entered the legendary mortgage era people still whisper about like it was some lost civilization. In the first week of January 2021, Freddie Mac reported the average 30-year fixed mortgage rate at 2.65%, the lowest in the survey's history. Read that again, 2.65%. That wasn't just low, that was economic steroids injected directly into the housing market. Freddie Mac Consumer Financial Protection Bureau. And here's why that mattered so much. When rates fall that low, buyers don't think in terms of price first, they think in terms of monthly payment. A house that felt expensive at 4.5% suddenly felt manageable at 2.65%. That single change pulled future demand into the present. People who might have bought in 2023 bought in 2021. People who might have stayed renters jumped in. People who might have bought smaller bought bigger. Cheap debt didn't just increase demand, it time-traveled demand forward. Consumer Financial Protection Bureau. Then came the second domino. COVID changed what people wanted from a home. Before the pandemic, a home was mostly where you slept, ate, and watched Netflix. During the pandemic, it became everything: office, gym, classroom, daycare, restaurant, therapy room. If you were stuck on Zoom all day in a small apartment, suddenly square footage wasn't a luxury, it was survival. And remote work made geography negotiable. If your paycheck still worked in San Francisco, New York, or Seattle, but your job no longer required your body to be there, then cheaper metros and more spacious suburbs suddenly looked irresistible. Think of the cities that became symbols of that era: Austin, Phoenix, Nashville, and a long list of Sunbelt boomtowns. U.S. Bureau of Labor Statistics. And this wasn't just a vibe, the data backs it up. A summary published by the Bureau of Labor Statistics, citing Federal Reserve Bank of San Francisco research, found that home prices rose 24% between November 2019 and November 2021, with remote work contributing to more than 60% of that increase. That is extraordinary. Not 24% over a decade, 24% in 2 years. That's the kind of move that permanently warps affordability for an entire generation. U.S. Bureau of Labor Statistics. This is the part people still emotionally haven't recovered from, because once low rates collided with remote work demand, homes stopped behaving like a consumer good and started behaving like a shortage asset. Homes didn't just sell, they disappeared. Listings went live on Thursday and had offers by Friday. People waived inspections, people waived contingencies, people bid far over asking because the fear wasn't overpaying, the fear was being locked out forever. That's how you get a market where buyers start rationalizing insane numbers with one sentence. Yeah, but if rates stay low, this might actually be my last chance. And once enough people think that way, the entire price anchor for the country shifts upward. Freddie Mac, U.S. Bureau of Labor Statistics. Now we get to the most important concept in this entire video: the lock-in effect. During the low-rate era, millions of homeowners refinanced or bought homes with mortgages under 4%. And today, according to the CFPB, nearly 58% of the 50.8 million active mortgages in America have rates below 4%. That means millions of homeowners are not just living in a house, they're sitting on a financial asset that no longer exists. A mortgage from 2021 isn't just a loan, it's a limited edition financial instrument. Consumer Financial Protection Bureau. And here's the prison part. If you sell that house today, you don't just sell the property, you also surrender the financing. You throw away the cheap debt. You trade a 2021 mortgage for a 2025 or 2026 mortgage that could be well above 6%. That's why people who would normally move for a bigger house, a new job, a new school district, or just life happening are staying put. They're not emotionally attached to the granite countertops, they're financially attached to the rate. Consumer Financial Protection Bureau. Let me put a concrete number on that. Take a $300,000 mortgage. At roughly 2.65%, the principal and interest payment is about $1,209 a month. At 6.5%, it jumps to $1,896 a month. That's a difference of around $684 every month. Over 8 years, that's more than $65,000 in extra payments. So when someone says, why don't people just sell and move? That's your answer. Because for many households, moving means volunteering for a 5-figure or even 6-figure financial penalty. Freddie Mac Consumer Financial Protection Bureau. And this is why supply stays weirdly tight. Yes, inventory has improved from the absolute bottom rock, but not enough to normalize the market. Realtor.com's February 2025 data showed that active listings were up 27.5% year over year, which sounds great until you see the other side of the chart. Inventory was still 22.9% below typical 2017-2019 levels. In other words, supply is healing from a historic wound. Meanwhile, homes were spending 66 days on market, and 16.8% of sellers were cutting prices, the highest February share of price cuts since that dataset began. That is the definition of a frozen market. Not enough supply to truly fix affordability, not enough affordability to create healthy demand. Realtor.com. So let's make this personal. Meet Maya. She's 31. She works in healthcare. She makes $74,000 a year. She has a 760 credit score. She has $31,000 in savings. She is not reckless. She is not lazy. She is not blowing money on bottle service and designer handbags. She did the thing adults are told to do. She studied, she works, she pays her bills, she saved. Zillow Media Room. And here's the punchline. Even Maya is still priced out. Zillow's 2024 affordability analysis estimated that buyers now need to make about $106,500 to comfortably afford a typical U.S. home, while the typical U.S. household earns only about $81,000. So Maya isn't just a little short, she's roughly $32,500 short of the income Zillow says is needed for a typical home. And if you use stricter 2025 affordability assumptions from Realtor.com, which estimate about $114,000 in income to buy a typical listed home under a 20% down payment under the 30% rule, the gap is even bigger. Zillow Media Room, Realtor.com. And that is the emotional violence of this market. It's not just that homes are expensive, it's that the people who did the responsible thing are discovering that responsible is no longer enough. Saving a house on Zillow that you already know you can't afford. Running calculators at night like maybe this time the numbers will magically change. Watching your rent clear every month while your down payment grows slower than house prices. That's not just financial stress, that's identity stress. It makes people feel like they're failing at adulthood, when really the math is what failed them. Zillow Media Room, Realtor.com. And the data shows this problem is not in Maya's head. The National Association of Realtors reported that the median age of first-time homebuyers hit 40. The median down payment for first-time homebuyers also hit 10%, matching the highest level recorded since 1989. That means the starter home stage of life is getting pushed later and later, and for many people, it's getting skipped entirely. National Association of Realtors. Now here's the structural part most people miss. COVID didn't create the housing shortage. COVID poured gasoline on a shortage that already existed. After the 2008 housing crash, builders got traumatized, credit tightened, land rules stayed restrictive, labor got scarce, material costs rose, and the country spent more than a decade underbuilding the homes people actually needed. Freddie Mac, Realtor.com. Host. Depending on the methodology, the shortage lands in roughly the same brutal zone. Freddie Mac estimated the U.S. had a 3.8 million unit housing supply deficit as of the end of 2020. Realtor.com later estimated the housing supply gap in 2024 was also about 3.8 million homes, or nearly 4 million. So when people say just wait for more supply, understand what they're really saying. Just wait for America to rebuild millions of homes after more than a decade of not doing that. That's not a seasonal fix, that's a generational repair job. And here's where it gets especially cruel for first-time buyers. We didn't just underbuild houses in general. We underbuilt entry-level houses. Freddie Mac found that new entry-level single-family homes, homes under 1,400 square feet, averaged 418,000 units per year in the late 1970s. By the 2010s, that number had fallen to about 55,000 per year. And in 2020, it was only about 65,000. Freddie Mac also noted that the share of entry-level homes in overall construction fell from around 40% in the early 1980s to around 7% in 2019. That is not a market accidentally becoming unaffordable. That is a market structurally failing to produce a starting point. Now let's deal with the question everybody asks. If affordability is this bad, why won't prices just crash? Because this is not 2008. In 2008, the system was full of fragile debt. Today, the picture is different. Homeowners with mortgages still held about $17.5 trillion in total equity in the second quarter of 2025, and the average borrower still had about $307,000 in accumulated home equity. That equity cushion matters. It means most owners are not being forced to dump homes onto the market at distressed prices. And combine that with the lock-in effect, and you get the key reason a crash is harder to trigger than people expect. Owners aren't over-leveraged the way they were in the subprime era. They're often sitting on fixed-rate mortgages they don't want to lose, plus substantial equity they don't need to liquidate. So yes, some overheated local markets can soften. Yes, prices can fall in specific cities, but a national collapse requires forced selling at scale. And right now, the structure of the market is still resisting that. So what's the honest forecast? Not the sexy one, the honest one. Not a glorious affordability reset, not a dramatic 2008-style crash, not a quick return to 3% mortgages. The most boring answer is probably the most realistic. A long, uneven, multi-year sideways grind. Low transaction volume. Inventory improving, but not enough. Affordability still broken. Some metros correcting, some metros holding up. National headlines swinging between housing crash incoming and housing market rebounds, while regular people feel like nothing is actually getting easier. So if you're Maya, or if you're watching this and quietly realizing you are Maya, what do you do? First, stop treating home ownership like a moral test. A house is not proof that you are disciplined, mature, or worthy. It is a financial decision, and when the math is broken, forcing the decision can break you with it. Second, stop comparing your timeline to your parents' timeline. Their housing market was not your housing market. Their rate environment was not your rate environment. Their price-to-income ratio was not your price-to-income ratio. You are not competing in the same race. And third, this is important. Renting and investing the difference is a legitimate strategy, not a consolation prize, a legitimate strategy. If the all-in cost of owning would destroy your savings rate, your emergency fund, your lifestyle flexibility, and your mental health, then renting while building liquid wealth is not falling behind. It is choosing not to buy a broken deal. Home ownership can be wonderful, but only when the math works. And if the math doesn't work, your job is not to romanticize it. Your job is to protect your balance sheet. So that's the paradox. Why are home sales near multi-decade lows while prices remain near record highs? Because the market isn't healthy enough to boom, but it isn't loose enough to break. It's trapped between a shortage, a lock-in effect, and an affordability crisis. That is the new housing market. And if you're feeling discouraged by it, hear me clearly. You are not failing at adulthood. The math is just broken.